What if I told you that um, selling an extra 1,000 units of your core product could be the exact decision that completely bankrupts your company?
Oh yeah, it sounds wild that it happens.
Right. I mean, you drop your price, you boost your volume, you're like celebrating a record sales month, and then you completely run out of cash.
Yeah, it's a very real trap.
Today, we are taking a deep dive into the hidden plumbing of profitability. We're unpacking an excerpt titled Chapter 9, Analysis of Business Profitability, just to demystify how businesses actually decide what makes money. Because it's not always obvious.
No, it really isn't.
By the time we're done here, you're going to view everything from retail clearance racks to, flashy startup office spaces through a completely different and honestly much more ruthless lens.
It is a phenomenal illusion, really. I mean, we love to look at a successful business, see the shiny storefront, and assume profit is just this solid, absolute number at the bottom of a spreadsheet.
Right, like you sell a thing for more than it costs you win. That's the logic.
Exactly. But beneath that surface, corporate accounting is this incredibly fragile, breathing ecosystem. And if management doesn't understand the underlying mechanics that we are about to discuss, that whole shiny storefront can just collapse overnight.
Okay, let's unpack this. We are going to use a hypothetical company from our materials as our lab rat today.
That's good.
Let's call them Raritan Manufacturing Company. And we're going to run Raritan through a series of stress tests using a remarkably powerful financial tool called break-even analysis. But before we can calculate when Raritan actually starts making money, we really have to understand how they spend it.
Because not all dollars leaving the building are created equal.
Right. And the foundational divide here is between fixed costs and variable costs.
Yeah, and identifying which is probably the most valuable thing management can do for effective decision making. Let's look at Raritan's baseline. They have fixed costs, so rent, management salaries, factory overhead, machinery repair.
Right.
These total $135,000. They pay this if they sell 1 million units, and they pay this if the factory sits completely empty.
The check clears either way.
Exactly. Then they have their variable costs, so direct labor on the factory floor and the raw materials. For Raritan, it costs exactly $35 in variable costs to manufacture one single unit.
Okay, simple enough on paper. But diving into the specifics of Raritan's ledger, I noticed something that just seems counterintuitive to me. Advertising and trade shows are categorized as fixed costs.
Ah, yes.
Wait, I mean, isn't advertising done specifically to drive sales volume? If I sell more, it's presumably because I spent more on advertising, which would make it a variable cost, right?
That assumption causes massive philosophical wars inside companies.
Oh, really?
Oh, yeah. We have to make a crucial distinction here. Advertising is volume motivated, but it is not volume driven.
Volume motivated, not volume driven, meaning I spend the money hoping for a result, but the expense itself isn't literally tied to the production line.
Right? Your direct labor goes up with every unit.
Yeah.
Your raw materials go up with every unit. But your trade show booth, it costs the exact same flat fee, whether you secure 0 contracts or 10,000 orders at that show.
Okay. The check to the convention center clears either way.
Exactly.
Which means the accountants see a flat, fixed expense. But I can totally see how a sales manager views it differently.
Yeah, and that tension is the root of this gray area controversy between managers and accountants. Like, the accounting department looks at an expense, say, warehouse logistics, and argues that, well, as volume goes up, the company will naturally need to send out more invoices or load more delivery trucks.
Right.
Meaning it's partially a variable cost.
So the accountants see costs creeping up incrementally with the activity.
But the managers responsible for those departments, they will argue until they are blue in the face that their operating costs are fixed. The warehouse manager will defend their budget by saying they don't hire or fire the logistics team on a week-to-week basis just because invoice volume fluctuates.
Right. They're like, these are my guys. I need them here.
Exactly. Their payroll is a fixed structural cost. It's just a constant battle of perception versus accounting reality.
Okay, so establishing Raritan's baseline here. $135,000 in fixed costs and $35 per unit in variable costs.
Yeah.
That brings us to the magic number.
The break-even point.
Right, how many units do they actually need to sell just to survive? So Raritan sells their product for $50 a unit. Their variable cost to make it is $35. That leaves $15 left over.
And that $15 is the contribution margin. It is arguably the single most critical number in this entire financial ecosystem.
Because it is not profit.
No, definitely not.
Every time Raritan sells a unit, the $15 of contribution margin goes straight toward paying off that $135,000 in fixed overhead. So with a fixed burden of $135,000 and a contribution margin of $15 per unit, Raritan has to sell exactly 9,000 units just to break even.
Which means if they sell 8,999 units, they operate at a loss. But the moment they sell that 9,000th unit, the structural overhead is completely paid for.
So it's kind of like filling a bucket with a hole in it.
Yeah.
The first 9,000 drops just keep the bucket from running dry, but drop number 9,001 is pure profit.
Exactly. That entire $15 margin drops straight to the bottom line because the rent is already handled.
Oh, I love that.
But what's fascinating here is how quickly management can misunderstand the leverage of that contribution margin and just completely destroy their own business.
Okay, let's look at the price reduction scenario from our stress test. So Raritan budgets to sell 10,000 units this year. At 10,000 units, they are 1,000 units past their break-even point.
Right.
So 1,000 units times a $15 profit margin means they're expecting a really healthy $15,000 operating income.
A solid, predictable year.
Yeah. But then a sales director comes in with a plan to boost market share. They forecast that by dropping the selling price from $50 down to $47, Raritan can push their sales volume up to 11,000 units.
1,000 extra units moving out the door.
For a sales team paid on revenue or volume targets, I mean, that sounds like a massive win.
It does, but let's run the actual math. By dropping the price to $47, the variable cost to manufacture the product stays firmly at $35.
Right.
So the contribution margin just shrank from $15 down to $12.
Ouch.
So they sell those 11,000 units. 11,000 times the new $12 margin generates $132,000 in total contribution.
But wait, the fixed costs are still $135,000? They fell $3,000 short of making rent.
Yes, by chasing volume and dropping the price just $3, Raritan goes from a $15,000 profit to a $3,000 operating loss.
Wow.
They successfully sold 1,000 more units, celebrated a volume increase, and bankrupted themselves in the process.
That is wild. It perfectly illustrates just how incredibly sensitive a business is to small changes in pricing when heavy fixed costs are involved.
Okay, so dropping the price across the board is a total disaster. But what about a targeted side deal?
Okay.
Let's say Raritan maintains their core $50 price for their main customers, but a new out-of-state distributor reaches out. They want to buy 1,000 units, but they're only willing to pay $42 a unit.
This is a classic business crossroads.
Yeah.
It's the exact moment where the intuition of a seasoned entrepreneur violently collides with traditional accounting rules.
Because intuitively, I look at that deal through an incremental lens.
Yeah.
My variable cost is $35. If this distributor pays $42, I am generating $7 of pure incremental profit on every single unit.
Right.
$7 times 1,000 units is $7,000 in free money. I mean, I take that deal every single time. Are you telling me the accounts would block it?
They will absolutely flag it as a massive financial loser.
How is making $7,000 extra dollars a loser?
Because of GAAP. Right, generally accepted accounting principles.
Exactly. GAAP requires manufacturing companies to use absorption accounting. Under these rules, accountants cannot simply look at the variable cost when valuing a product.
Okay.
They are legally required to take that $135,000 fixed factory overhead and allocate it across the manufactured units.
Wait, so they have to attach a slice of the factory rent and the management salaries to every individual widget rolling off the line?
Yes, it's referred to as the fixed cost burden. So if Raritan budgets for 10,000 units, the accountants divide the $135,000 fixed cost by 10,000. Every single unit now carries a fixed cost burden of $13.50.
So the accounting report says the variable cost is $35 plus the $13.50 fixed burden, making the total fully loaded cost of the unit $48.50.
And if you agree to sell it to the new distributor for $42, the absorption accounting statement will definitively show that you lost $6.50 on every unit you shipped.
That is wildly infuriating. I mean, it's like, this is like me renting a two-bedroom apartment. The monthly rent is completely paid for, and my salary covers it.
Sure.
And a friend asks to crash on the couch for one night and offers me $50 for the inconvenience. And my roommate, the accountant, intervenes and says, you can't take the $50. Half a month's rent is $500, so mathematically you're losing $450 by letting him sleep here? The rent is already paid.
That analogy perfectly captures the absurdity of using historical accounting rules for future strategy.
That's crazy.
The fixed costs are already covered by Raritan's main business operations. Any revenue generated above the variable cost on a special order is just gravy. But this gap requirement, it causes deep structural distrust between accounting departments and executive management.
I can imagine.
The accountants are strictly following reporting rules designed to accurately value inventory for past tax periods. But management mistakenly uses those backward-looking reports to make forward-looking business decisions.
And the truly smart companies engineer entire business models just to bypass this illusion. Like our text talks about brands like Overstock.com or Nordstrom Rack or Brooks Brothers outlet stores. They
Exactly.
essentially exist to capture this exact type of incremental profit without triggering those accounting traps.
They recognize they have excess capacity or inventory that has already absorbed its fixed costs. They want that $7 of incremental margin. But they can't simply drop the price of their premium product in their main stores, or they risk, cannibalizing their core business and ruining the brand prestige.
So they spin up an entirely separate off-market channel. They dump the product in an outlet store where the consumer expectation is just different, securing that pure variable profit while keeping the main brand's pricing structure fully intact.
It's a brilliant workaround. But when companies fail to grasp how overhead allocation distorts reality, the results are just tragic. There is a well-documented case of a highly engineered electronics company that fell victim to this exact absorption accounting trap.
Right, their primary revenue engine was selling expensive high-tech hardware. But they also operated a consulting segment that helped customers design the systems using this hardware.
The problem was the accounting department mechanically allocated a massive chunk of general corporate overhead. So the CEO's salary, the corporate headquarters, leased the HR department directly onto the consulting segment's ledger.
Forcing the consulting side to carry this massive artificial fixed cost burden.
Right. And on paper, the absorption report made the consulting segment look like a chronic underperformer. It appeared to be just barely breaking even or occasionally even losing money.
Oh, man.
So executive management, looking strictly at the GAAP compliant reports, decided they couldn't afford to subsidize a break-even division and ruthlessly shut the entire consulting arm down.
Thinking they just saved the company from a financial drain. What was the actual fallout?
Absolute disaster. Obviously, the minor cash flow from consulting fees evaporated, but far more destructively, their highly profitable hardware sales instantly tanked. It turned out the consulting division was the very mechanism driving the hardware sales. The system design advice was exactly what gave customers the confidence to buy the expensive electronics.
They killed their golden goose because it was wearing a disguise made of allocated overhead.
Yes. To stop the bleeding, the company had to desperately start giving away the consulting and design advice for free just to get the hardware moving again, all because they were blinded by an accounting illusion.
That's rough.
And furthermore, the overhead costs they thought they eliminated didn't actually disappear. They just got reallocated to the hardware division, crushing those profit margins on paper too.
Okay, so we've clearly established that heavy fixed costs, this unavoidable burden, can trap a company, artificially inflate paper costs, and lead to catastrophic strategic decisions. So the obvious next question is, how do modern businesses escape the trap of fixed costs altogether?
Well, the modern playbook heavily revolves around strategic outsourcing. Let's return to Raritan Manufacturing. Currently, they operate their own distribution facility, which saddles them with a fixed warehousing expense of $20,000 a year. They are analyzing a proposal to fire their warehouse staff, shut down the facility, and contract an outside logistics firm, let's call them Warehouse Inc., to handle all fulfillment.
Okay, so they eliminate a solid $20,000 in fixed costs. What's the catch?
Warehouse Inc. doesn't charge a flat fee. They charge a variable fee of $2 per unit shipped.
Ah, okay, so we are fundamentally restructuring the DNA of the company's spending here. We're trading a fixed cost for a variable cost. So Raritan's total fixed costs drop from $135,000 down to $115,000. But our variable cost to make and ship a single unit increases from $35 to $37. Does this actually improve the company's survivability?
It radically alters the math of survival. Remember, Raritan's original breaking point was 9,000 units.
Right.
Let's recalculate with the new structure. You divide the newly lowered fixed cost of $115,000 by the new contribution margin, which has shrunk to $13.
Because of the extra $2 per unit.
Exactly. The new break-even point drops to 8,846 units.
Oh, wow. so they can sustain a noticeable drop in sales volume and still keep the doors open.
The general principle is this. At lower volumes or during periods of high uncertainty, substituting fixed costs for variable costs significantly minimizes your potential losses. And this wasn't just a theoretical exercise. This was the dominant corporate survival strategy during the brutal 2007 to 2009 recession.
When the economy collapsed, companies were ruthlessly shedding payroll and closing plants just to survive the sheer drop in demand.
They were desperately trying to lower their break-even points. But a fascinating macroeconomic shift occurred. Many of the internal functions previously handled by the employees who were laid off, IT, HR, logistics, specialized manufacturing, they were immediately outsourced.
Right.
A significant portion of the newly unemployed workforce started independent contracting businesses or joined specialized vendor firms, ultimately selling the exact same services back to their former corporate employers.
Because the corporations didn't stop needing the work done. They just financially re-engineered it.
Exactly.
They swapped a fixed payroll obligation for a flexible variable vendor invoice. Here's where it gets really interesting to me, though. The rise of the internet and cloud computing has essentially dismantled the traditional model of vertical integration.
Oh, absolutely.
It used to be that a serious company owned everything, the factories, the trucks, the servers. Now the internet operates as this frictionless global supply chain, where you can plug into a variable cost vendor for literally any resource on Earth.
It has created an unprecedented era of opportunity, particularly for startups. It fundamentally changes how you launch a business. Consider the launch of a new management consulting firm. The text talks about the traditional or wrong way to do this, which is basically a masterclass in break-even nightmares.
I love this example. So the wrong way is leasing 15,000 square feet of prime commercial real estate, hiring an expensive interior decorator, installing a massive server room, hiring 15 top-tier consultants on salary, and launching a massive marketing campaign, all before you have secured a single paying client.
You've just engineered a company that is essentially born bleeding. You have zero incoming revenue, but you've locked yourself into a monthly cash outflow of perhaps $50,000 to $100,000 in pure, inescapable fixed costs.
It's terrifying.
Your break-even point is stratospheric. Unless you have secured massive venture capital funding to absorb those losses, the company will suffocate long before it finds product market fit.
So the modern right way leverages everything we just learned.
You meticulously examine your core competencies. You execute a ruthless SWOT analysis. You start the firm from your living room where the commercial rent is zero.
Right.
You focus purely on networking and business development. You do not spend a single dollar on infrastructure until you have a signed contract and a client retainer in hand. And when you finally land that project, you hire specialized experts on a freelance contract basis.
A pure variable cost.
Yeah.
You only pay for labor when you have revenue explicitly tied to it.
Exactly.
You keep cash outflows as close to zero as humanly possible. You aren't truly an operational business until you have a revenue-producing event.
You outsource absolutely everything that isn't the direct value you're providing to the client.
But there is a ceiling to the strategy, right? I mean, you can't just run a Fortune 500 company entirely on Upwork freelancers and rented servers forever.
That is the critical mathematical tipping point. Operating with a structure of purely variable costs is phenomenal for startups and for surviving deep recessions because it artificially suppresses your break-even point.
Okay.
But what happens when the business scales? What happens when Raritan isn't selling 10,000 units, but 50,000 units?
Well, suddenly paying Warehouse Inc. $2 a unit starts to look like a massive financial drain. $100,000 in variable fees is way more expensive than just renting the $20,000 warehouse and doing it yourself.
Exactly. Once a company surges past its break-even point and achieves high sustained production volumes, bringing those functions back in-house, intentionally taking on heavy fixed costs, becomes the secret to unlocking massive profitability.
Understand.
It's how you achieve economies of scale. Below break-even outsourcing is the ultimate shield because you aren't paying for idle overhead. But above break-even fixed costs act as an accelerator, allowing you to maximize the profit margin on every additional unit sold.
I see.
The lowest cost producer inevitably dominates the market, and at scale, minimizing costs requires vertical integration.
Okay, so we've engineered the perfect lean startup, we've survived a recession by outsourcing, and we've scaled up by bringing operations in-house. Strategy and planning look brilliant on a spreadsheet, but no business survives contact with reality untouched. When the fiscal year ends, how do you actually spot where your cost strategy broke down? And this brings us to variance analysis.
Yeah, variance analysis is basically the post-game film review.
Okay.
It is the process of comparing what you meticulously budgeted to what actually transpired in reality, and then acting as a forensic accountant to determine exactly why there is a discrepancy.
Let's run the post-game on Raritan's here. So the top-line news is great. They budgeted to sell 10,000 units, but they actually sold 11,000.
Mm-hmm.
Now we look at their variable costs. They budgeted their direct material cost to be $5 per unit.
Right.
For 11,000 units, they expected to spend $55,000 on raw materials.
But the actual end-of-year ledger shows they only spent $52,250 on materials.
A positive variance. They came in nearly $3,000 under budget. I mean, standard logic suggests the purchasing department did a stellar job. Maybe they negotiated a bulk discount for the higher volume or optimized the cutting process to reduce scrap waste. The purchasing manager is probably expecting a huge bonus right now.
On an isolated spreadsheet, it absolutely looks like a major victory. But effective variance analysis requires evaluating the entire ecosystem. Let's shift our focus to the factory floor and look at direct labor.
Okay.
Raritan budgeted $10 a unit for labor. For 11,000 units, they should have incurred $110,000 in labor costs.
But the actual show, they spent $111,000.
Yes.
A negative variance.
Yes.
The production floor blew the labor budget by $1,000. What if the company was so incredibly efficient at buying materials and reducing waste? Why did their labor costs get completely unhinged?
This is the ultimate crucial insight of the entire profitability analysis. Intelligent management requires that you do not make judgments in departmental silos until you connect the dots across the entire supply chain.
Okay.
Direct material costs were unusually low. Direct labor costs were unexpectedly high. The forensic connection. The lower material cost was likely achieved by purchasing inferior, lower quality materials.
The purchasing department bought cheap, out-of-spec garbage to make their own budget look good.
Exactly. And because the materials were brittle or improperly sized or full of defects, the highly paid factory workers had to spend significantly more time wrestling with them on the assembly line.
Oh, man.
Products failed quality checks and had to be routed back for manual rework. Finished units had to be repaired by hand to ensure they were acceptable for the customer. The extra overtime and labor costs completely vaporized the supposed savings generated by the purchasing department.
That is incredible. So the negative labor variance wasn't an issue with the factory workers being slow. It was directly inflicted upon them by the purchasing department chasing a bargain.
It perfectly illustrates a foundational business truth. Looking for bargains in your supply chain is rarely an effective long-term strategy. As the text states, the days of compromising on quality to save a few pennies on the margins are over.
Right.
Quality of product is no longer a negotiable variable. If you try to cheat the system on materials, the system will brutally tax you on labor and rework.
So we've journeyed from identifying the DNA of a company spending, the divide between fixed and variable costs, to navigating the incredibly treacherous waters of GAAP accounting, where a highly profitable incremental deal is disguised as a massive loss. We've explored how modern businesses literally hack their break-even points through outsourcing to survive economic winters. And we just uncovered how a positive budget variance in one siloed department can act as a delayed fuse bomb for the rest of the company.
The overarching lesson is that business profitability is never a static, isolated number. It is a highly dynamic, deeply interconnected system.
Yeah.
A single pricing decision or a single vendor change sends mathematical ripples through the entire structural foundation of the company.
It completely rewires how you observe the commercial world around you.
It really does. And if we follow the trajectory of everything we've discussed today, specifically regarding technology and the shedding of fixed costs, it raises a fascinating question about the future of commerce.
Oh, what's that?
Well, the internet, global logistics, and cloud computing have made it frictionlessly possible to outsource almost every traditional business function.
True.
Manufacturing, warehousing, human resources, accounting, IT, all of these used to demand massive, heavy fixed costs. Today, they can be transformed into purely variable pay-as-you-go services.
The ultimate supply chain of the internet.
Right. So if that macro trend continues to its logical, absolute extreme, Are we approaching an economic future where a corporation is no longer a physical place with thousands of salaried employees and massive fixed assets?
Wow.
Is the multi-million-dollar company of tomorrow simply a single entrepreneur sitting at a laptop in a coffee shop, acting as an air traffic controller for a completely decentralized global network of variable cost freelancers and API services?
A massive global enterprise with zero fixed costs,
Hmm.
zero real estate, and a break-even point of exactly 1 unit. That is a wild paradigm shift. The next time you walk past a shiny retail storefront or look up at a massive corporate headquarters dominating a city skyline, don't just see success. Ask yourself how much of that glass and steel is an actual strategic advantage and how much of it is just a massive fixed cost burden silently waiting to drag the entire ship under the moment consumer volume drops.
It definitely forces you to completely reevaluate who actually possesses the stronger, more resilient foundation.